Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I like to play an economist on TV, but I am joined by the star of the show, the one, the only, my favorite, Anthony Esposito, our trader extraordinaire from Ascalon 6 Capital. Anthony, how are you doing? How was your week?
EJ, good to be here. And the week was good. The month has been crazy. We've had a successful month in the middle of a real crazy market. The headline risk has been pretty high, and a lot of unknown unknowns, meaning no idea where the bombs will come from, headline bombs, and what the results will be with the market. So we've had a large back and forth in equities that kind of got us going, which was fine. We were on the right side of that. Gold and silver ripping. Volatility has been a good trade. It's just been crazy, but we're doing well. Definitely happy with the results for the month as we come into the tail end of it and trying to get through this WEF week of ridiculousness. I think, it's been interesting, and you and I talked about it, and I know you're crazy busy, but and watching 1,000 things as well. The criticism that we kept hearing was, Trump is such a critic of the World Economic Forum, and Trump is, now he's going to hang out with his rich friends and hobnob with the same people he criticized. And I'm like, nah, he pretty much went there to tell them, listen, I'm going to let you know who's in control. We'll be polite about it, but kind of letting you know who's calling the shots and how this is going to go. We can talk, but at the end of the day, we're going to be where we're going to be. What's your take? I mean, I've known you. I know you have watched this and you've listened to Trump out there. But the take on Trump at the WEF, did he succeed in letting everyone know or reminding everyone for sure who he was and who was in control?
Yeah, Anthony, I think that's exactly the takeaway. Yeah, it was a tour de force, quite frankly. He went in there, guns a-blazing, and it's not as if he's going in there as a kind of paper tiger, if you will. He approached this, I think, really from a position of strength. He's got the hottest economy in the world, the biggest economy in the world, and he has learned how to wield the American consumer's purchasing power like a weapon on the world stage via tariffs. And obviously other metrics too, but you can't discount how big of a role tariffs have played in this administration. And so, look, when you have 5.4% estimated economic growth for the last quarter, when you have inflation coming down, when you have the huge amount of investment that's pouring into the country right now, I mean, all the dials are really lining up. We're seeing so many productivity gains from AI. We're seeing a resurgence in energy production. I mean, again, he's going into this, and his counterparts have all of the opposite. They have stagnating economies. A lot of them have immigration crises that they just haven't dealt with. They have inflation that's still not under control. Maybe not as bad as it was 2 or 3 years ago, but still not under control. They have all hamstrung themselves in terms of energy production, in terms of industrial production. Again, they're so dependent on the U.S. economy, and so much more so than we are on them, that they can't afford to do things like go toe-to-toe in a trade war. So again, I saw his speech not only in terms of what he said, but the background, which was a position of strength that nobody else could really match. And so when you put those two things together, it is kind of like, in a certain sense, it's Teddy Roosevelt, speak softly and carry a big stick. The big stick is the incredible economic performance that we're seeing in the U.S. right now. I'm not sure Trump really had the speak softly part of it down. He was more so like, no, this is my big stick, and everybody gets to see it as I wave it around.
That's pretty well put. He definitely, I love the delivery. I love the message. And I really do like it was a recount back for everyone sitting there as to why would you do this? Why would you move away from fossil fuels? Why would you load up on wind turbines that don't work, wreck the environment, and aren't sufficient? Why would you move away from nuclear and go to solar, which is completely inefficient? Why would you open your borders? Why would you? I mean, he put them on the spot and asked the questions. And then the fact when he said, which was one of my favorite points, China is the number one producer of wind turbines. However, China does not use wind turbines. Is anyone thinking? Is the critical thinking starting to happen, or are you guys all that far gone? I think that was amazing, and I think the fact that the cabinet was with him You had you have Rubio there, you have Lutnick there, you have Besson who was lights out there.
Oh,
That was amazing. And I actually want to get into Lutnick in a second. They all delivered perfectly, poised, in control from a position of power. And then you flip and you have Al Gore heckling from the stands, and you have Newsom kind of kicking the dirt, putting in the seat in the corner in the back with the dunce hat on because they won't give him a chance to speak. Like, it was a win-win across the board, and I think that, as usual, Trump came out on top with the right message, able to execute, and able to let people know I'm actually in control. I'll be polite about it to a point, but I'm actually in control. I want your take on Lutnick. Lutnick, I like Lutnick. I have known him for a long time in headline and in common circles on Wall Street. Obviously did a great job at Cantor, no denying that. Since he's been with the administration, I've been okay with everything he said. I haven't really been thrilled or thrown, kind of fell off my seat by anything. However, he did come out and he did talk about the globalization of the world economy. He nailed it. And I think it was by far the best delivered message from Lutnick since he took his seat with the administration. I want to run that and get your take on it.
Okay. We are in Davos at the World Economic Forum. And the Trump administration and myself, we are here to make a very clear point. Globalization has failed the West and the United States of America. It's a failed policy. It is what the WEF has stood for, which is export, offshore, far shore, find the cheapest labor in the world, and the world is a better place for it. The fact is, it has left America behind. It has left the American workers behind. And what we are here to say is that America First is a different model, one that we encourage other countries to consider, which is that our workers come first. We can have policies that impact our workers. Sovereignty is your borders. You're entitled to have borders. You shouldn't offshore your medicine. You shouldn't offshore your semiconductors. You shouldn't offshore your entire industrial base and have it be hollowed out beneath you. You should not be dependent for that which is fundamental to your sovereignty on any other nation. And if you're going to be dependent on someone, it darn well better be your best allies. Okay? And so that is a different way of thinking. It is completely different than the WEF. I viewed the WEF as not a flagpole in the middle, but in fact, they are the flag. Whichever way the wind blew, so it blew. You should have solar, you should have wind. Why are you going to do solar and wind? Why would Europe agree to be net zero in 2030 when they don't make a battery? They don't make a battery. So if they go 2030, they are deciding to be subservient to China, who makes the batteries.
Let me ask you a question, EJ, as we're listening to this. I remember being on the floor of the stock exchange in the 90s, and I remember getting a memo specifically from Dick Grosso, who was the CEO of the exchange at that time. You remember at that time the exchange was private. And the exchange was, we had 90% market share of all cash equity trades in our name. So it was a pretty powerful force. It's still arguably ARCA NYSE is, but at that point, it was powerful. I remember getting the memo about globalization of markets, about the potential of listing foreign companies, about the potential of this great expansion. Okay. And I will say that we head into the WTO allowing China access or membership in 2003, 2001. And the move into this globalization of the economy destroyed us. Not only did it destroy our border, but it destroyed our worker. It destroyed private growth. It exported US dollars globally at a rate that has completely destroyed has damaged the worth of the dollar. So the workers, we lost jobs, we lost wealth, we exported everything that made us so special. And I think this administration gets that now. So what do we need to do? In my opinion, we need to find better labor, more efficient labor, more effective ways of doing things and producing privately within our sovereign, secure borders. That's the move here. We need private investment within the country. You're all over this. You study this all the time. This is a futures trader talking about globalization of economies. How bad of a move was this, and how long, or what do we need to do to really reverse this trend? And do you think we can do that?
I think you can definitely do it. It's certainly possible to reverse the trend. You know, Anthony, when I talk to a lot of folks about globalization, some of them have a real hard time wrapping their heads around why you would make certain decisions that are not necessarily the most efficient, let's say, for the moment. And I liken it to driving a car without insurance. Now, obviously, you have to have liability insurance. That's required by law. But let's say there weren't any rules in terms of insurance requirements, and you could just choose. Not only do you want the comp and collision portion of your car insurance, but even do you want to carry any liability at all? You get to decide all of that. Well, theoretically, if you're going to be a very safe driver and not cause an accident, but also if no one else is going to hit you, if you can make all of those assumptions, then yeah, the most efficient choice would be to not carry any insurance. Sure, because why would you outlay all those premiums for no upside? But that's not the real world. And the problem is we took a lot of those assumptions seriously, and we pretended as if they were the real world. And that's how you get into a situation like 2020, where you have offshored so much of not just your manufacturing, but critical supply chain to unreliable partners like China. And even your pharmaceuticals. I mean, we had shortages of all kinds of drugs because we couldn't rely on getting them from China anymore. But in the short run, it was the most efficient way to do it. And so when you don't account for all of these additional risks, including geopolitical risks, then globalization sounds like a real winner. But as soon as you start factoring all that stuff in, you realize it's not the best. It's not going to give me the best outcome in the long run. And that's why even though liability is obviously required for car insurance, but comp and collision isn't, people still choose to get that. They still choose that additional coverage. Why? Because they know there's a risk, and they're willing to part with the money in terms of those premiums in order to be protected from that risk. And that's what part of this, if you want to call it nationalist, I'm not sure exactly what the word is, maybe just call it the America First economic agenda. Part of the rationale behind that is you need to make sure you are isolated from those geopolitical risks, because if you're not, if you let, Anthony, this just go to its logical conclusion, you become dependent on all kinds of foreign actors, including some bad actors. And that's the position that Europe is in right now. Why is it European nations truly cannot forcefully intervene in the Ukraine? They can't, because they're still dependent on Russia for energy. In fact, since the war in the Ukraine started, the European nations have given more to Russia in the form of purchasing energy than they have to the Ukraine in the form of aid. They're literally financing both sides of that conflict. And it's all because they essentially laughed Trump out of the room during his first term when he said, you guys need to diversify off of Russian energy. But they didn't. Why? Because globalization told them, in the short run, this is the most efficient place where we can outsource our energy. And that's what they did. And they're reaping the fruit of that.
Look, I'll tell you what, America First should not be an objective statement or an objective view. And any leader within the history of the country, any leader elected to any public office that is not America First and couldn't see this through should be ashamed of themselves, should never have been in office. And I'll go one step further. The amount of money that was kicked back and paid back to our elected officials, including former presidents, in order to continue this machine of outsourcing U.S. wealth, I would love to see a real investigation into that. I would love to see a real effort to find out what money came back from what nations, and I want those people held accountable, because this is trying to be efficient, but it went beyond that. It went from being efficient to fundamentally changing and destroying the structure of the country and the U.S. economy and the U.S. worker. In addition, we've imported tens of millions of illegals. Let them come in, let them filter into the system, and to either suckle off the system and put us further into debt, or take jobs that otherwise, and houses that otherwise would have been taken, and seats in classrooms, and beds in hospitals that otherwise would go to U.S. citizens that deserve them, that are entitled to them, and that are working for them. So I hear you on the efficiency. I can't get over how incompetent our country and our leaders have been over the past, let's just call it 75 years from the end of essentially the end of World War II. I do want to flip over to the markets because they've been crazy, and we talked a little bit last week about it, EJ. And I want to go into the S&P and gold, and I'm going to start with the S&P. We've had this just roundabout. Last week, I was talking about the 7,000 resistance level. We had what looked like a relatively large intermediate term, so multi-month ascending triangle, with the expectation that we would break out above 7,000. Mm-hmm. But I did say, and I've been writing, 7,000 is the spot to watch. So in my opinion, what happened here is we had the right call at 7,000. We actually here at Ascalon 6 got a negative signal from our proprietary model on Friday on the close, subsequently saw a gap down. So on that close Friday, we were up around the 69.80 level on the front month futures for the S&P. We gapped down to a low of about 68.20. So that was about a 3% sell-off that we saw. And I had a 6,800 target on this move. So our target, we came within 20 points of our target. We were positioned well. It was aggressive, but it kind of was building at the 7,000 level. And then these headlines that we see, is there going to be a conflict in Iran? Are we going to do anything or bomb? The Greenland situation, kind of looking at it now, you can look back and say that was silly, but it was on top of mind. Is there going to be a renewed tariff war? Kind of silly looking at it, but it was top of mind. I truly believe that headlines are interchangeable. I am, and we here are in a quant rule-based, technical analysis-driven model. So for us to see the weakness at 7,000, the headlines didn't matter. I truly believe the market was dying for a reason to kind of blow off and then reestablish itself. So the initial call was good. You'll notice that those two bars, that big black bar down, and then yesterday's big white bar up, we held the 100-day moving average on both of those bars on a closing basis the day before, and then we broke below on an intraday basis yesterday. And then as Trump started to speak at the WEF, we really started to get some clarity. And I think essentially what we saw was people were short and pressing those shorts. People were looking for a 6,700 tick, maybe a 6,550 tick on the S&P. Saw that they weren't going to get it, and we entered into the short cover rally mode. It was manic buying. I mean, we had, I think, over 250 points in swings on the day in the S&P. So we had a big rally up off of Trump at the WEF. We had a sell-off of another 80 handles, and then we had a big rally to finish the day. So it was an aggressive day, a good hold on the 100-day. We came within 20 points of our downside target. We're now moving higher. We're getting above the 69.60 level, which was a resistance level for us. We're at 69.67. And I do believe at this point, with that blow off down and that hold, we've seen the shorts kind of clear and get satisfied and then get squeezed out. I think we'll continue to see momentum kind of heal because there was a big drawdown in our momentum trend indicators. I think we'll see those improve. 7,000 will get tested. And I would say looking forward, and this is just me kind of projecting out, we'll see how it acts at 7,000, but we're getting kind of close now. I think the 7,000 level will give way near term. I think we do see 7,100, 7,200, which was a target I talked about for the past 3 weeks. I did say a week and a half ago that it was not going to come as soon as I thought, and to be cautious and to start to back away from the longs, which ended up becoming the right move. But I do see us testing 7,000 again. I do see us getting higher. And then I think it starts to become really tricky as we get through earnings. There are some tailwinds from the Trump agenda, GDP, inflation numbers coming down. You could look at those employment numbers actually positively. You can look at the Fed is ready to cut to some degree because we have President Trump appointing the new chair, who obviously is going to be in agreement with President Trump. You don't appoint people that don't agree with you. You appoint people that you think will do the best job. So typically, logically, if we're thinking objectively, that would be people that would be looking for lower rates. I'll finish on the rates thing. I don't believe that lower rates will effectively do what the market thinks they'll do. We've been chasing lower Fed funds rates for 26 years now, and I think it will create an up move, but it won't sustain an up move. And the reason I believe that is because of the massive debt that we have. I think at this point, any rate cuts will go towards helping service that debt. They're going to get gobbled up by that debt. I don't think that they're going to create a real push for the market as it has in the past. I think that'll be a little more short-lived, but we'll see. So essentially from 69.60, I do see upside through 7,000 here, potentially 7,100, 7,200, but 7,000 is the spot. If we start to stall there and our model shifts back down, that's going to be a pretty bad warning sign. A failure there now, we will undercut the recent lows. I don't think that's the higher probability. I think the higher probability is 7,100, 7,200, and then let's see how it acts. I think from there we could see a potential drawdown even further from where we are now. But for now, the move is to the upside. The market seems to be grinding, whether it's short covering or positioning for a higher move. That's my call on the S&P, and we'll keep it up. And next week we'll run through the next chart. We'll update this and see where we're at. As far as gold goes, gold has been an absolute monster. Gold is, and I won't be too long-winded because I don't want to torture you. Gold is one of our main tradables in our basket. We're up about 47% in gold in the commodity since last July. So it's been a massive run. And we've seen a real push out recently. And that was exacerbated by a couple of things over the past few days. One, we had a lot of geopolitical risk coming to the front end where people thought, Trump was going to invade Greenland. I mean, we just had the Venezuela situation. We have Greenland, still working on Iran, still working on Russia, Ukraine. So there was a spike up there. We also had a real move out of the JGBs. We saw a massive sell-off in Japanese government bonds, and that kind of triggered a move higher in yields across the globe for sovereign debt, and the fear that would continue. That incremental buyer of government bonds, sovereign debt, which makes total sense because we're all way over levered. But that incremental buyer has gone from sovereign debt into gold, which makes perfect sense, especially with the amount of debt that's outstanding and what the dollar's doing and the inflation risk and geopolitical risk. It all plays into the scenario. The recent spike, we have a 3-day 6 or 7% spike in gold. That really was exacerbated by the fear in the market and then the sell-off in the JGB. So we're watching gold now. Front month generic gold at 49.12, absolutely insane. We have seen, if you look at that regression track, that upward trend, we've seen two so far real moves down or corrections within, not corrections, but retracements within that move. The first one was, was in October of 25. We saw an 8% move down. That's to the far left of the chart. And then we had one December 29th. We saw a little over a 6% or almost a 7% move peak to trough within the track. And now we're kind of reaching back up again. If we were to follow suit here just as a point, and we were to get down to the mean of this track, so this is a regression track with a mean for the move up and then standard deviations out above and below that mean. If we were to see a move down from current levels, it would be about a 6 or 7% move down in gold to the mean, to the middle of this track. It wouldn't be breaking the trend, but it would be a reversion back into the middle of the trend, the meat of the trend. I don't think that's irrational. I don't think that's something that we should be discounting as not possible. Gold is going to continue to grind higher. I called for gold at 5,000, back at 4,300, 4,400. We called for gold at 3,000 to 3,500, back at 2,600. This has been, it's an aggressive trade to sit in, and most people don't realize the whip and the nastiness of the day-to-day. However, if you zoom out and you look at the daily, the weekly, the monthly chart, we're headed towards 5,000, I have no doubt. I would just caution people that within that move, we could easily see another 7% drawdown to the middle of this trend as we continue our grind higher. So just be aware of that. But gold overall is the story's not breaking. The tailwinds are there. They're going to continue to be there, and I think it puts you in a good position to be long, just understanding that there's going to be some whip and potential for a real drawdown. So that's the S&P right now. That's gold right now. I hope that's helpful. If anyone has any questions, you can go out to the website. There's plenty of information there at askelon6capital.com. I'm out on X at CMT_Anthony. And you can always feel free to email me at anthony.esposito@askelon6capital.com. So that's the spiel from the trading desk today. That's the profit side of the podcast. EJ, sorry that was so long-winded, but
no, I love it. Are you kidding? I love the
I
info.
really appreciate your assessment of the WEF and where we stand, and globalization of markets was, as usual, spot on.
Well, likewise, Anthony. Love all the insights on the market.
Thank you, sir. Thank you very much. You be good. I know the week's been crazy. I know I'm hoping you're up in New York soon. I would love to get together and grab a steak and a old fashioned if that's possible. In the meantime, buddy, I appreciate it. Great analysis, and I'll keep following you on X at real EJ Antoni, and I'll see you next time.
Sounds good, Anthony. Till then, have a great week.
Thanks, man.